this video I'm going to be talking about inputs and outputs, and then also the dollar figures which track those. And it's pretty straightforward, I think, to view the model of production in any kind of a business firm production system, regardless of what's being produced, whether it's physical goods like toasters or ice cream, or whether it's a non-physical output like a tax return or a haircut. The thing that we can know about all inputs is inputs create costs. And so inputs, whether it's labor, whether it's materials, or any other kind of machinery or any other kind of thing that goes into the production process, has a cost, has an outflow. In addition, outputs, that is the things which are created, whether it's the tax returns or the toasters, create revenues, because the idea is that they're eventually sold to somebody, so there's an inflow as a result of that. So it's important to think of the inverse relationship between inputs and the flow of funds. Things go into the hopper, but there's an expenditure of cost as a result of that. Outputs go out the door, but then money comes back in, and so as a result, we sort of tie this back to the circular flow model. And I want to talk a bit about the relationship between inputs and outputs, in particular a mathematical relationship known as the production function. And there may be, I don't believe that there's an actual explicit description of a production function in the text. There are some very famous ones that exist, but all it really is simply the mathematical relationship between inputs and outputs, the quantity of inputs versus the quantity of outputs. And so this leads us then to talking about something called marginal product. Marginal product is simply this. It's simply defined as the change in total product or output produced. All total product is simply output produced, divided by the change in some input. And in this case, we'll say the labor is the input, although it could be capital goods like machinery and equipment, in which case we could say it's, we usually use the symbol K for capital. Let's just keep it relatively straightforward and look at it as labor here. So it's the total amount of, the change in total product divided by the change in the quantity of the input of labor. And so as a result, if we move along this graph here between 1, 2, 3, 4, X number of workers, what we see happening is this. We can graph this and notice that we have an initial bump here to the amount of output being produced. That is, with one worker we produce this much output or quantity. It's the quantity that we already know. Another worker adds more to the production process. But a third sort of begins to tail off the change in total product divided by the change in quantity of the input of labor. And then it goes down from there. And so once again, just like as in the case of marginal utility, we have once again a diminishing function. Marginal product is a diminishing function. So over time, we see this fall off. And there's an explanation for a couple of different parts of this, and that is here, there's oftentimes a gain in productivity once workers are added to a production process. And if we're not talking about labor, we're talking about capital goods, any kind of an input like capital goods, or in this example, labor. There's an initial boost in productivity due to things like division of labor, specialization of individual workers as they get better at doing what they do. And so there's this particular benefit. But over time, all production functions are thought, theoretically, to have a diminishing function because of the fact that as we add more workers to the production process, we lose the benefits that we initially had from specialization and division of labor. We begin to have overlapping of responsibilities. We begin to have interpersonal conflicts. As we increase the scale of people working, there's a span of control issue in terms of, is management able to supervise a larger number of people as opposed to a smaller number? All those kinds of things lead to this particular diminishing function that we call diminishing marginal product. Okay, so marginal product of labor, if labor is an input and inputs create costs, then how do we account for these changes in costs? Well, we know that we've got a big boost at 3 levels of worker here. And so as a result, we can carry that down here to this particular area. And we have a new function that we'll talk about, and that essentially does graph the cost issue, and it looks like this, and we simply call this marginal cost. If marginal product of labor is the productivity of labor as we add additional amounts of workers, the marginal cost is the actual dollar figure to employ labor at this particular level of production. This is the Q, the same Q as over here. And all marginal cost is simply this. Like all these marginals that have delta something over delta something else, it's simply the change in total cost divided by the change in the quantity of the output. And notice that we get this sort of fishhook type configuration, and that is that increased productivity leads to decreased costs on the margin. And when we say on the margin, we're saying as we go from one incremental level to the next. And it's almost like if you took this and sort of flipped this through the board, there is sort of a symmetrical image here, and this is not accidental. The idea is that the boost in productivity is a reduction in cost per unit, but then the fall off in productivity as more workers are added in terms of labor means higher costs as one goes from one incremental level to the next. And marginal cost is really one of the most important concepts in microeconomics. It's one that we're going to be coming back to again and again and again. It is the incremental cost of production as we go from here to here, from here to here, from here to here. And wherever we are in the production process, understanding marginal cost is important. You might not see this very much in accounting or finance, but you definitely do in economics. In fact, the determination of where a business firm is with regard to the marginal cost of production as it plans to go from one incremental level of output to the other is really critical for understanding where the firm is in relation to its key objective, that of maximizing profit. And that concept is going to tie in very closely with maximizing profit as we progress throughout this course in the next few weeks. So I hope this was helpful in understanding how the production function works and in terms of the illustration of marginal product and its relationship to marginal cost. And in the next video, we'll take marginal cost and put that together with the other relevant costs that are applicable to the individual business.